Ladies, gentlemen, while I sit here in my pajamas, I'm stuck with a 2020 dilemma as a dividend investor, and I'm going to tell you what I mean by this, but let me show you some AAA rated companies and what their current yields are. Taking a look at something like Apple at a 0.98%, a company like Microsoft at 1.24%, one of my favorite utilities of all time, Southern Company, at a 3.75% yield, and some of my more recent purchases like MO at 6.58% and BTI paying at a 5.76%. Now, why am I showing you these dividend yields? Well, I've only been purchasing these companies for the last 2 years or so. Some of these are as recent as last year, and the yield on cost has changed so drastically, it's starting to make me an uneasy investor. Let me show you what I mean here. In my yield on cost on my investments with Apple at 1.78%, you got Microsoft at almost 2%, and then my British American Tobacco 6.82%, MO 7.39%, and heck, my utilities paying at a 5.6% yield. Some of these yields are double what they were almost a year or two ago, and this is really changing the landscape for investing. And I think as a dividend community, it is smart to start recognizing this and how can we go forward in 2020. I look so forward to breaking this down for you, so let's just jump right into this.
Drop it.
Welcome back, my passive income investors alike, to the 2020 dilemma of the dividend value investor. I'm going to be making some very bold predictions in this video, and it's going to be fun to see how these come into fruition over the next year. But if you are a value dividend investor like I am, you're probably taking in some dividend payments. I'm making about $450 a month, and it's slowly starting to drip into my accounts, and I'm trying to figure out how to best allocate this. But the landscape of the markets have changed so drastically in the last year. Finding good deals is getting harder and harder. Chances are you follow the philosophy of finding those top companies that pay really good dividend yields, cost averaging into them, and then holding on to them for the rest of your life. But if you are new to investing, that is becoming a bit of a challenge to want to achieve, because these top rated companies are starting to get into the what I call FOMO stage, fear of missing out. If you look at the S&P 500, most of these top tiered companies are pushing into some absurd valuations. And as a value investor, I'm even looking for those recession-proof companies, your companies like Proctor and Gamble. But these companies a year and a half ago, let's use Procter & Gamble as an example, was paying out a 3.5–4% yield. Today, it's only a 2.36%, which leads us having to do digger deeping and digger diving into these companies to find something that might be considered valuable where it currently sits. Now, the problem with this is this happened in real estate about a year or two ago. Real estate went on such a crazy run, and everybody and their grandmother wanted to get into deals. It started becoming a lot more competitive, and that is what the market is becoming, because the only deals out there are companies that come with more risk. Companies like Carnival Corp is one that I recently talked about because it's paying out a 4% dividend yield. But the problem with Carnival Corp is that it is not a good recession-proof stock. And when the market's pushing to all-time highs, you want to be protected against any severe downside risk, because a lot of us, I think, are following this philosophy of cost average in and buy good companies. But because now that they've introduced fractional share buying, the news isn't affecting the stock market, and everything just keeps going higher and higher, and it's becoming the most recent expectation. I think people are losing touch of reality and what could potentially happen. There was a recent video that came out on Valuetainment talking about this Iran conflict, and I'm sure you've heard about the bombings and all the stuff going on in the last few weeks alone, and it's the first time ever on Twitter that World War III was trending, but none of this news even put a blimp on the stock market. And I really think this has to do with the fact that people are following an ignorant yet good standard of investing, because a lot of us are buying those index funds, cost averaging into these good companies, but you can't do that today and expect the same rate of return you did over the last 2 or 3 years. It would almost be insane to think that is a possibility. Taking a company like Apple again, for example, one of my favorite companies of all time. How can a company that is worth it's like $1.3 trillion, in order for Apple to double even in the next 5 or 10 years, it has to go up to a $2.6 trillion market cap. Is that possible? Absolutely, but you have to imagine those numbers, and that is not an easy thing to achieve. I honestly couldn't have predicted Apple going to the price that it did. So what are my current predictions for the market? Well, in the macro, I honestly think the S&P is going to start slowing down. I honestly think these top tiered companies, people are starting to shift away from them into these smaller cap, maybe like the Russell 2000 stocks, because in the last couple of weeks, these small cap stocks have been outperforming the large caps. And I think that's because it's the only place people can find deals. But with small caps come higher risk. So where in the market do I think the best deals are going to be going in 2020? You're probably not going to agree on me with this one, and I do not have real big exposure to this, but I'm talking about the MJ sector. Now, the MJ sector has been one of the most beaten up sectors in the entire stock market, and people have really shunned away from it at this point. Now, this is an extremely risky way to go about investing. I had a lot of luck with Canopy Growth Corp. I made about $30,000 when I finally stepped away from that company, but taking a look at where all the MJ sectors sit today, they have been beaten into the ground so hard. Now, you don't have to agree on me with this. I don't have a huge share value in any of this except for Crom, which is exposed through MO. But the reason that I'm saying the MJ sector is probably going to be where the most value is going to be in 2020, and it's going to be really fun to see if this comes into fruition. And the reason I'm saying this is because the government, for the first time in a long time, since it's been legalized, has finally loosened the laws up. The biggest problem with the MJ sector is none of these companies are unique. They all sell products people are growing in their backyards as of recent, but we're going to start seeing who's going to be winning this game because revenues are increasing in some of these companies, and now that the government's finally loosened up the laws a little bit, we're going to start seeing some incredible growth, I think, in maybe a select handful of these companies. So if we sit here and wait for a few more quarters while they finally introduce edibles, while they're finally opening up 1,000+ dispensaries, I think we're going to start seeing some big turnaround stories in select few companies. Now, the problem is I don't think you're going to be able to figure out what select few companies are going to be able to outperform, so you might as well just sit here and wait and see what ones are going to do the best instead of gambling. Now, it is not an advisory to go out and start dabbling in this incredibly risky sector, but if you compare this to any other growth stock out there right now, and especially AAA rated ones like Apple, like Microsoft, heck, even the more risky ones like Shopify, these things are just getting to a point where they're just not going to be doubling like they used to. But in the MJ sector, where companies have finally been beaten up so bad, I think we're finally sitting at a bottom. Now, this is talking about the entire sector as a broad, and I do not recommend buying the ETF either. A lot of people are always shocked because the HMMJ ETF pays an 8.3% dividend yield, but you better do your homework on that because the reason they pay that dividend yield is through short options. They were obviously preparing for some volatility in the future, so they took some short downside risk just in case, and they've been using it to pay out a dividend. There's honestly so much going on out in the world right now with people selling day trading platforms. Everyone's making a ton of money. Things are getting very fruitful to the point where it's starting to not make sense. And I haven't said this before. Back in the day, I was always really hesitant about a recession. And over the last few years, I have been really bullish on the stock market. But I think this is the first time where my gut feeling has really turned into the other direction. It seems like every other day right now, the portfolio is hitting all-time highs, and I don't know where to put this money. There's still some deep value, I think, within the Canadian sector, within the MJ sector, and my banks you could consider a deal, but currently the way the banks have been going, they haven't really been growing the bottom line that much, which has been keeping them at a steady, flat pace. But for dividend payments, sure, that's fine, but I'm looking for growth and dividends, and if I can get that out of one company, I'm very happy, and that would be a company like MO or BTI, which I was buying last year, because those kind of companies, you're getting them on such a deep discount, you're going to see a quick return in the share price, and you're also going to be collecting a very fat check. But I cannot see myself wanting to invest in Apple, wanting to invest in Microsoft. It just doesn't make sense here, and the numbers are not adding up. Sure, these companies are showing great bottom lines, but people are getting stretched. I think this is something that people keep forgetting has been a big problem, which is things like student loans, car loans, the fact that most people are still incredibly broke, and those are the people that are making us rich. Now, are we going to start seeing some, leveling off or maybe even a correction at some point this year? I'm not talking about a recession. I'm not saying any of that could even come into fruition. I'm just saying when things get to this level where there's this much debt out there, those people that are raising up the markets, those people are going to get stretched, and we usually have what is called a credit cycle. If you don't know what a credit cycle is, you really need to go read up on this because this is how the markets work. When interest rates drop, people take out more debt. When people take out more debt, they're purchasing more things. they're investing it, and they're doing all this stuff. But sooner or later, the chicken's got to come back to roost, and all of a sudden, the interest rates are going to go up. And then what's going to happen is the markets are going to completely level off, if not take a correction. And then on top of that, everybody else out there that has just been spending money frivolously on cars, student loans, all this different stuff, they're going to be experiencing a really tightening moment on their wallets and their bank accounts as the interest rates go up. And what we get with the credit cycle is you see these boom and kind of bust cycles where all of a sudden the market can be exploding, but then again, the chicken comes back to roost. People actually have to pay their debts off. Things get a little bit more tight. And then all of a sudden we see a big restriction on the market. A credit cycle is something we haven't experienced since the 2008 recession. And this is something that would typically happen every 10 years. I'm going to leave some resources in the description below, and it's something that I'm going to suggest that you severely take the time to look up on, because market cycles are a reality, but not anymore, which makes you really have to start to question, has the landscape of the markets changed altogether, or is something much, much more sinister going on here? And I'm always going to bring it back to this quote from Janet Yellen. Back in 2009, after the 08 crash, Janet Yellen said, "There will never be another financial crash like 2008 in our lifetime." So far she's been right, and we've all been making a lot of money. But keep your backs up, ladies and gentlemen. Keep diligent here, because this is not at all normal. So stay cool, stay awesome, guys, and I look so forward to chatting to you tomorrow.